Good morning. I'm Gord Long with the Financial Repression Authority. As part of our ongoing series on the Austrian School of Economics, I have Chris Casey of Winrock Wealth Management joining us here this morning. Welcome back, Chris.
Hi, Gordon. Thanks for having me on.
Well, it hasn't been that long since we've had you on. I really enjoyed our last show, and I'm very much looking forward to talking about the Austrian School of Economics here, and specific to a really great article that you wrote on inflation on it. But Chris, maybe for some of our listeners that didn't hear you the first tape we did, could you give them just an outline of your background and Winrock Wealth?
Sure. Well, I've been following and reading and studying Austrian economics for about 20 years now, ever since I was in college. I frequently write about Austrian economic theory, not just from a broad-based economic theoretical standpoint, but also as it relates specifically to investment applications. Currently, I'm Managing Director at Winrock Wealth Management. We're a registered investment advisor managing money for high net worth individuals. And we try to combine a unique macroeconomic top-down perspective, specifically the Austrian school, along with an entrepreneurial mindset that sees on unique investment opportunities. And that's kind of our story.
Chris, jumping right in, how would you describe to somebody that's not familiar with it what the Austrian School of Economics is about and what's important about it?
That's a great question because, frankly, I've never really seen a great explanation of Austrian economics.
It's amazing, isn't it?
It truly is. Let me give you a little bit of an insight I had the other week. I was reading a book completely unrelated, but it's a famous novel called The Greek Way by Edith Hamilton, and it's discussing ancient Greece. And there's a line in there that struck me as relevant to Austrian economics, amazingly, and it was that she said the Greeks were the first civilization to put man at the center of the universe and man's mind at the center of man. And I think that's also applicable to Austrian economics. And here what we have with Austrian economics is the study of man's survival. That's what economics is, the study of survival, man's survival within nature. In Austrian economics, unique to the economics discipline, looks at basic self-evident axioms as relates to mankind in nature, and then uses deductive reasoning to create theories about how the real world works. And for that reason, I think it's the most realistic interpretation of economics and society, and I think it's far better than some other economic schools out there that may use an ad hoc method and try to test things, which you really can't do in any social science, let alone economics.
You know, it's as you said it well. It's a very practical, common sense view of how the world and people and behavior work is what I've seen. You know, and as an old engineer, you know, was heavily into mathematics and laws of physics, but I think a lot of the economics today have got too esoteric in terms of mathematical models, and they're all based on nothing wrong with those, but they're based on assumptions, and assumptions change quickly. You're in a fiat currency, debt levels, and they can distort reason and logic in it. I don't think anything's more blatant than quantitative easing right now, but that's another discussion. What do you think the key tenets are right now in the Austrian school that we really need to focus on in this era of financial repression? Because this is new, fiat currency is new, and Austrian school was around before we had both of these.
Sure. I think there's two central areas where Austrian economic theory lends itself not only to just basic investment concepts and ideas, but also to protect people against any kind of financial repression. And those are, as it relates to Austrian business cycle theory. So the question is, why do we have recurring recessions, every so often within society? And secondly, as it relates to inflation. The Austrians have unique explanations for both the economic phenomena of inflation as well as business cycles. And I think that's really the key takeaway for investors.
Okay, well, we're going to talk about inflation, but let's talk about the business cycle. How would you describe that in regards to their concept of their business cycle, how they look at it?
You know, the Austrians did something, and this is mainly from Murray Rothbard in America's Great Depression, his fantastic work. They looked back at society and said, when have we had recessions? And what you find is that we really didn't have them, or at least a cycle of recessions, before the 19th century. So because of that...
About the era of the Federal Reserve coming into existence.
Oh, well, certainly it's been more pronounced. But really the 19th century is when we started first seeing these cycles, if you will. And the question became, or the self-evident by many mainstream media thought, well, what it is that's when the Industrial Revolution happened, and so capitalism is to blame. There's somehow recessions are inherent in capitalism. And the Austrians said, no, that's not the case at all. Really, there's a different institution that came around at that same time frame, and that's central banks. And so when you have central banks, when you have fiat currencies, they're ultimately to blame. And the theory is pretty basic, and that's, in fact, one of its strongest criticisms by Keynesians, is that when central banks create fiat money, when they create money out of thin air, and then they go ahead and they bid on assets, typically government bonds, they're distorting and lowering the interest rates. Now, when you do that, there's several key factors. Businessmen always use the interest rate structure in order to determine making long-term decisions about capital. And when you distort that rate, when you go ahead and you lower it, it causes businessmen and economic actors throughout society to make decisions they otherwise would not have done. And so they're making poor investments, malinvestments, if you will. Either they're investing in too much or in the wrong things. And when you do that, inevitably, there'll be a period where you have a recession, when these investments do not prove profitable and they have to be liquidated. And that's what we know as a recession.
Chris, just staying on this whole idea of inflation, the article that you wrote in talking about inflation from an Austrian perspective, could you really expand on that and take us through the key concepts that you had in this article? Because I think it's very powerful.
Sure. Well, the article is basically comparing and contrasting various schools of thought as to what causes inflation. And let me first run down what the mainstream economics, the Keynesians, believe does cause inflation and compare it to the Austrians. They believe, since the days of Keynes, that it's what they call demand-pull inflation. So everyone's heard about an overheated economy causing prices to increase. They believe that somehow aggregate demand, even if that can be quantified, even if it does exist, somehow outstrips aggregate supply, and suddenly we have prices are bid up. The problem is that means you can only have inflation during periods of economic growth. And we saw from the 1970s, and we've seen it throughout the world, that's not the situation. Inflation could be completely invariant to economic growth. In the 1970s, we had the price level doubling over that decade.
Chris, I interrupt. I lived through the 70s, and I know you can have both. We did not have full employment, but we had high levels of inflation. We did not have full capacity, and we still had inflation. Serious inflation. I had a 19% mortgage rate being renewed at one point. I know about it, so it's garbage. But somehow the Keynesians have got away with this, if I can be a little harsh.
They did get away with it, and primarily because they dusted off another theory of inflation that was in their back pocket called a cost-push inflation. And this one I think is even perhaps more incomprehensible. And what their theory is that if you have a particular commodity like oil that goes up in price, and that's what we had in the 70s for various reasons, they believe that permeates throughout the economy from a standpoint. If you're paying more money for that now higher price good, you have less money to spend on other goods and services. And when you have that, that creates a downward pressure on those prices. So in the aggregate, there should be no change. On top of that, that's the theoretical standpoint, it doesn't comport to economic facts. So let's look over for the last 15 years. The price of oil, maybe in 2003, it was $25, ran up to 2008, or well over 100. Went back down after the Great Recession, and then went up, and now we see it back down to around 40. Well, does anyone believe the price level has jumped around corresponding to that change in oil price? It has not. And so cost-push inflation is a fallacy as well. So those are the Keynesian ideas of what causes inflation. And so they obviously don't comport with economic reality. And because of that, I think the Austrians are much more aligned with what actually happens. And they look at money, look at prices, I should say, as merely a function of supply and demand for money. So the more supply you have, eventually it will cheapen the currency, meaning prices of goods and services go up. The more demand you have for money, that bids down the value of goods and services as people want to hold larger cash balances. So it's a very simplistic theory of inflation, but it comports with the proposition of value for every other good and service. It's merely a function of supply and demand.
And I would support that. And I would make another point on that, Chris. My observations, it's money supply today, we get caught up and we think of it on a sovereign level, on a country level. But the world no longer operates that way. We operate on a global economy, and where money moves, whether it's bonds, credits, etc., is clearly there. So today, it's the supply of money globally and the demand for that money on a global basis. And there are so few systems out there that really correctly measure it so that you can effectively look at it. One of the things that we look at very heavily is the global reserve levels, which is a function of how much money is being supplied out there. And if you notice, the reserve levels have been dramatically falling in China, and the reserve levels globally now have rolled over and appear to be moving down just recently, which lines up with why we start to see heavier deflationary pressures in the short term.
Right. Well, I think that's a valid analysis of looking worldwide at various stocks of money and seeing how they change over time. Especially in today's world, I think that makes a lot of sense.
Where do you see inflationary pressures going forward? We clearly have inflation now in asset classes in certain areas. We have deflation in other areas. So we can have a mixed bag within countries and globally, which I think confuses people. But where do you see it going when you look at your crystal ball out over the next year?
Well, I believe that, first of all, they certainly have created enough money where, all things being equal, we can have significant inflation going forward from what's already been done. However, I think that the impact of that money printing will be mitigated by economic weakness for the time being. And by that I mean it's not because the economy is doing well or not, it's because it affects the supply, right? We're based on fractional reserve banking, so the weaker economy means that those funds aren't being put to work.
And you're referring here, for example, that we have over $3 trillion in excess reserves at the Federal Reserve right now that the banks aren't using in a fractional reserve system.
That's absolutely correct. So it really takes some digging into the supply side to understand where it truly is. But the way I think things may play out, whether it's the next year or even a longer time period, is that this economic weakness, I think we're effectively at the beginning stages of a recession here in the U.S., will affect the stock markets. And once we have another downturn, we've seen this with the last two minor corrections, whenever we have that, the Fed steps right in and they try jawboning the markets up again. And if that doesn't work, we think they're going to step in significantly with greater injections of money. Maybe they won't call it QE, they'll call it something else. We think that's the most logical progression. Once we have that, once we have this new quantitative easing round, combined with what's already been done, I think that's when we'll really start to see the inflation take off across countries.
Chris, we are in total agreement with your analysis. We've referred to it for a couple of years now as an M top, and the inside of that M is this real deflationary pressures we have now. The outside of the M, whether you get a double top or a higher top, is going to be this next round of central bank experimentation. And it comes in different forms. I have a chart here now that shows a roadmap of what we think could possibly come out of it. Could see quantitative easing 4, or whatever they want to call it. I'm sure they'll come up with a creative name. Overt monetary funding, or what's more commonly called helicopter money, which gets into other kinds of questions. Negative interest rates, not just ZERP, but NERP, and everything that goes with that on war on cash. But those are some ideas and collateral guarantees that we see. What do you see? What kind of form do you think they'll use to create money? Can you speculate on that?
Well, that's a good question. One of the things that I haven't seen discussed, but I think would be the easiest thing to do, really it's a two-stage process. Number one, you referenced the excess reserves that commercial banks have with the Federal Reserve. They're paying them right now 25 basis points on those reserves. That was supposed to be a temporary measure. Temporary as in fall of '08. I would not be surprised if the first thing they did was either eliminate that or reverse it, where they're actually getting paid. And once you do that, once you push those excess reserves out there, you can do some other things. It may not be actually printing money. What they could do, and maybe I should step back for just a moment, the Federal Reserve really has three mechanisms at their disposal, right? They can manipulate interest rates at the short-term level in order to inject money into the system. They could actually print money, so they print money out of thin air and buy various assets. But the third aspect that hasn't been done in quite some time, and would be in tandem with the change in excess reserves, would be to change the reserve requirements on banks' assets.
Which is an incredibly powerful tool.
Yes,
that China uses quite regularly, and others do, but we haven't been playing around with it.
We haven't. Right now it's at about 10%, so that allows banks to effectively increase the money supply by tenfold for every dollar in demand deposits. Some countries don't have reserve requirements. I think Australia is probably the most notable exception there. And so there's no reason the Federal Reserve can't say, okay, now it's 5%. And that particular mechanism to inject money into the system is extremely not only powerful, as you mentioned, but probably most pronounced in its timing. It should have an immediate impact.
What about just avoiding the banking system entirely in regards to what is called helicopter money? That is, giving money. They're referring to it now as quantitative easing for the people, and that is, it's directly created and passed directly to the people as a stimulus process, as in the form of a.
That's certainly an option. I mean, we saw that effectively under Bush, the second Bush, right? He just mailed checks to everybody under a certain income level. That's possible. I don't think it's the most effective route that they will take,
okay.
Partially because it helps undermine their fiscal situation more so than perhaps other methods. So I think they'd rather have more of a stealth increase in the money supply by using central banks instead of sending money directly to people.
Back to your article, Chris. What were the conclusions of the article?
Well, it's mainly that we should be seeing, although it's certainly delayed in the impact relative to historical examples, some significant inflation out there fairly soon, whether it's 6 months or 2 years. The conclusion is that what has been done since August of '08 is unprecedented in the United States and throughout most other countries. And if Milton Friedman was right, even Milton Friedman said he knows of no situation ever in the history of mankind where the money supply has increased substantially where you haven't had a corresponding increase in the price level. And so it should follow. It's just the devil is in the details as far as timing.
Chris, final question. As a well-known practitioner of the Austrian school, how are you translating that into your investment portfolio thinking, your wealth management planning right now?
Well, we believe that you can't put all the chips on red, meaning you shouldn't go in and think, I'm just going to prepare right now for the big payday when inflation hits or when the economy falls off a cliff and the stock market falls down. Timing is everything. It's the most unknown, though. But what you do know is the direction and the magnitude of these changes that are going to take place. And so we're firm believers in using investments that do fine right now, that pay well. But if there is these economic developments that we anticipate, there'll be home runs. And so you want to look at hard assets, inflation hedges, whether it's farmland, precious metals, maybe some certain foreign currencies, residential real estate. We think these all make a lot of sense in anyone's portfolio.
Chris, can you tell our listeners how they could learn more about your other writings that you do and Windrock? Sure.
Well, we post all of Windrock's material, whether it's articles, podcasts, etc., on our website. It's all cataloged right there by media as well as by topic. And so I would encourage anyone just to visit our website, which is windrockwealth.com. It's also the easiest way to contact us. But more importantly than we think the most important thing is that they become familiar with our philosophy, look at the materials, and if they like what they see, we're happy to work with them.
How would they learn more about the Austrian school? What's the easiest or best way there, would you recommend?
Well, if you went to Mises.org, which is a think tank for the Ludwig von Mises Institute, which was for those listeners that don't know, a very prominent Austrian economist, there is probably several lifetimes' worth of free information that you could find from there. There's one particularly well-done pamphlet that describes what is Austrian economics and walks through the basic tenets, and also kind of describes some practical measures from it.
Well, thank you very much for your time, and we are going to have you back again, and we're going to pick up this theme, especially if we start to see the Fed playing around with any of these programs we talked about and the reserve requirements, which I will smell also. Again. Talk to you later.
Thank you, Gordon.
Bye-bye.